Hello everyone, welcome to my channel. Today I'm going to discuss about the topic on what is bond ETF and why you should include them in your portfolio. If you have not subscribed to my channel, please hit the subscribe button now so that you can get alert on the future investment video like this from me. Thank you. Before I explain what is a bond ETF and how different is it from normal bond, first let me explain what is a bond. A bond is like you are giving a loan to a company for a period of time. For example, 5 years, 10 years, or even 30 years. In return, the company will pay you a coupon either every year or every half a year. When the bond reaches maturity, the company will return the principal amount back to you. However, buying bond does carry some risk. One of the most important risks is default risk. Imagine lending 200k to a company. After the first coupon payment, the company goes bankrupt and default on the payment. You will lose everything. On top of that, most of us are not accredited investor or big investing institute. Therefore, the type of bond that we could buy in Singapore is very limited. To reduce the risk of default and increase the choice of bond, we can invest into bond ETF, which is just an exchange traded fund listed in the stock market and trade just like any other stock. But the underlying asset of this bond ETF are actually many different bonds, which means bond ETF actually allows investors to diversify their investment into different bonds, thus reducing the risk of losing everything if one of the company goes bankrupt. One major difference between a bond ETF and bond is bond ETF never reach maturity. Usually, when the bond is near maturity, it will be replaced with another bond in the market. Therefore, your principal amount is not guaranteed. So, before we get into why we should add bond ETF into our portfolio, let's take a look at the example over here. If you have $10,000 capital and you invest everything into S&P500 ETF from 2010, you will actually get a very significant return at the end of 2020, close to 5 times returns of the original amount invested. However, during bad time like COVID period or earlier debt crisis, you will see significant drawdown on your capital, up to 25% drawdown during COVID period. On the other hand, if you invest 100% into bond ETF from 2010, you will see no significant drawdown on your capital during most crises, but you will see very little gain on your capital over 10 years. So, is there a way to enjoy high return but lower drawdown or volatility during bad time? Turns out that there is a way, which is instead of investing 100% of your capital into a single fund, you can diversify by investing 40% in S&P 500 and 60% into bond ETF. So the return of this portfolio is shown on the orange line here. Notice that the drawdown during crisis is significantly reduced from 25% to 14% only. However, the trade-off is a lower return than if you invested 100% into S&P 500. You can play around with the allocation of capital between equity and fixed income fund. The return of your capital will then be somewhere between the green and the blue line. Therefore, in conclusion, it is still beneficial to add bond ETF into your portfolio with the objective to reduce uncertainty during bad time. For example, some people who are looking at drawing from your portfolio as a form of income, having a stable portfolio with lesser uncertainty will allow you to draw from your portfolio even during bad time. Thank you for watching my video. Hope you have learned something new and useful. If you like the video, please help to like and share it with your friends. See ya, bye.